You don't need to be a statistician or an actuary or, a CFA level three to know that the front page of the Wall Street Journal is now every day showing another private credit fund under stress. And so, I think we're on the doorstep of a credit event.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. With the U.S. at war with Iran, oil prices spiking, private credit likely imploding, and payrolls sinking, it's perhaps understandable that some investors are worried that the world is going to hell. To put everything in perspective for us today, likely using more than a few F-bombs himself, is Chris Irons, author and publisher of QTR Fringe Finance, which has become one of the most popular financial newsletters around, currently sitting at number 27 in the list of top 100 financial Substacks worldwide. Chris, thanks so much for joining us today.
Happy to be here. Thank you.
Well, it's really fun to have you back, Chris. Really enjoyed your inaugural appearance on this program. Suffice to say, a lot has happened since then.
Yeah.
Um, and You made a great statement last time about stocks being pornographically overvalued. I want to ask you in a bit if we're still at that stage. But before, I just kind of gave a brief litany of some of the headline worries that are out there right now. From your perspective, just how bad are things? Is it really all that bad, or like most things in life, is there more nuance at
Well,
play?
I mean, how bad are things, or how bad do they look? Because they don't look that bad, right? Like nominal price of the stock market continues to go higher. The valuations, I mean, we've come off a little bit here, but we're pretty much as stretched in terms of valuations as we've ever been historically. I don't know if the question is things are bad in the sense that the way things look aren't the way that things are. And that's the story we're kind of seeing in private credit right now. You got a whole sector full of mismarked books and level three accounting that needs to be adjusted and is starting to be adjusted. And as that's happening, you're seeing people rush for the exits in concert together. And you're seeing redemptions getting gated and, bigger and bigger. Last week it was a $26 billion fund. Yesterday was a $33 billion fund, getting 7% redemptions. And so the shit's kind of hitting the fan in private credit. The overall market's the same deal. It's like, how does it look? Well, it's inflated from money printing and it's being bid up by the passive bid and the options market and money printing. Essentially, the passive bid sprays retirement capital to a market weighted index, and that propels the indexes higher, despite the fact that market breadth may show 70% decliners to advancers. If the 30% that are advancing are the right names, the index goes higher. And so, you know, how are things? I mean, most people would say, like, oh, things are good. But under the surface, you have things like the cryptocurrency sector, which could arguably be, it doesn't matter if you're bullish or bearish, but it's probably the tip of the spear if you wanted to make the argument that one whole sector could be worth nothing. Um, so you have a lot of a trillion or $2 trillion in market cap there that could theoretically like go to zero, or at least theoretically doesn't have a floor or a bottom from any fundamental perspective. And you have a long list of companies that are trading at even more aggressive valuations than the indexes themselves are at, specifically in AI. But then, like, you have a lot of cash losing companies that really have no business even being public or having a bid, that are trading at extremely excessive valuations. So, I guess things are good. They look good, but there are significant pockets of air underneath everything. And, having positive real interest rates still each day kind of caustically whittles away at the euphoria in the market little by little, day by day, and limits companies' ability to attract new capital or to refinance. And so, you know, I guess things look good now, but under the surface, I mean, you could make the argument that they're not as good as they look, and that's what you're seeing in private credit now.
All right. So other than that, Mrs. Lincoln, how did you enjoy the play? Okay. So, you had used that term pornographically overvalued last time you were on. Obviously, you still think valuations are a big issue from what you just said. I'm just curious, the markets have sold off a bit from their highs, and they've cooled a bit during the war here. Would you downgrade your comment from hardcore porn to softcore porn, or are we still at
Not
hardcore porn levels?
not really. I think the excuse me. I think the issue that needs to be considered more than are we extremely overvalued or just very overvalued, because whether we're at whether the Schiller PE is at 40 or 35 doesn't matter. What matters is whether or not we are actually going to revert back to historical averages when it comes to PE ratios and market cap to GDP and those things. If we do eventually revert to those historical norms and the averages that have been set over the course of whatever, 130 years or 140 years, then yeah, then there's an argument that, okay, we do have a 50% drawdown possibility in the future, obviously before the Fed comes in and puts a bid under the market. But really, there's also a case for, and I've written about this on my blog, there's a case for things just being different now. And
Hmm.
I know that that's something that somebody like me would just laugh about usually, because it's a play on the idea that every time there's a bubble, people say it's different this time. And I started to kind of seriously consider whether things really are different, whether 20 or 25 times earnings is now the new, trough, 10 to 15 times earnings, which would have been in the past. And the reason being is we're out of control with quantitative easing. And that was never the case from, whatever the first 100 years or the first 90 years the Dow traded. So when you want to look at historical averages and you're going to work in numbers from 1906, you had a market that was functioning very differently than the way the market functions now. And I'm not just talking about structurally, like, options and trading 24 hours and the passive bid and all that shit. Putting all of that aside, which is, it does make it fundamentally a different type of stock market. You have unlimited quantitative easing coming at any point. The market has a sharp drawdown of whatever, 5% or 10% at any point. And to the extent that that's going to continue, it is actually worth asking the question, is 20 times the earnings now like the new deep value? And trust me, like nobody hates hearing me say that more than me. But I do think it's a topic worth exploring. I think, during COVID, I think forward earnings estimates got down to like 18 or 15 times earnings. COVID was a pretty gnarly, nasty sell-off. Like in events like those in the past, you would see the S&P get close to single-digit PE ratios. And so, the floor may have just been raised slightly by virtue of the fact that the mechanics that power this market are totally different than they've ever been, and they're going to be, which is why you don't just see the stock market going in a chart of the Dow from the left side of the screen to the right. You don't just see it going up, you see it going parabolic, right?
Hmm.
Which is just shows the rules of the game changed, once we started into the 2000s. And so again, a better question is not are we overvalued, but how are you even thinking about calibrating this market to valuations to begin with?
So, Chris, I know you do your own interviews from time to time, and I'm curious, have you ever interviewed Hugh Hendry? Do you know who he is?
No. Yeah, I do know he is. I've never
Okay.
interviewed him.
I actually haven't interviewed Hugh either, but I would recommend that you reach out to him, even just to have a conversation off record. Hugh is pretty famous, as you may know, for basically coming to that same epiphany that you just talked about. Soon after the GFC, when the central planners rushed in with the initial QE programs. And he basically, he had been very vocal about pointing out a lot of the vulnerabilities of the current system. But then he kept watching what the central planners were doing, and he basically, it was sort of like a Doctor Strangelove, like I just came to love I learned to love the central planner response. I mean, he hated it
Right.
while it was going on, but he just said, look,
But it is what it is, right?
yeah, he's
Like
like, it's a
it's not going to
juggernaut that I just
change.
can't lay in front of. Yeah, if I lay in
Right.
front of it, I'm going to lose all my investor capital. And he eventually famously sort of shut down his fund and returned money to investors and just said, I can't continue to invest the way that I have my whole career because I think there's been a sea change in the way that markets work. And I kind of hear you saying you're potentially arriving or at least contemplating a similar conclusion.
Yeah, I wish I would have arrived at it when he did because I would have made a lot of money, but I didn't.
So, all right, then I feel like we've just fast forwarded through a lot of middle ground to get to the real meat of things here. So, okay, you write your newsletter, your job is to try to help your readers make better informed decisions about their investing. And obviously you invest your own money. So what are you doing with this wrestling match that you're having right now? Are you contemplating going more long than you otherwise would have before, or like what are the investment outcomes
Not
of this?
Not really. I think, the what I try to point out on the blog is just the other side of the coin when it comes to a lot of things. And so just to try to shed what is increasingly becoming a scarce fundamental light on the markets and on companies themselves. So if
Mhm.
you step outside of Hugh Hendry's market circus that you're describing, it is still worth noting the fact that, look, no matter how much the Fed prints, like if you own equity in a company that's burning cash, you still own equity in a company that's burning cash. I mean, like, the stock valuation may be higher, but like, there's going to be some type of fundamentals to look at. And that's generally what I try to do. And I try to explore like, asymmetric opportunities, sectors that are kind of like being ignored or show promise that otherwise would not be thought of. I mean, I have written about individual names. Mostly I write about sectors in general. Um, and I don't really give advice. I just kind of write about things that I think, a lot of things I write about I don't own. Some things I write about I do own. Um, Coming into last year, I was focused on nuclear energy. I think we talked about on the first podcast, gold and
Mhm.
silver miners, which obviously, the I do like 25 picks at the beginning of the year, and then I chart how to do over the year. This year I did 26 for 26. Last year being very heavily weighted in gold miners and uranium did incredible. That, little mock portfolio beat the S&P by like 50%. This year still ahead of the S&P by like 5 or 6%, but have kind of spread around through a couple different sectors that I was not in 2025, for example, kind of stepped a little bit away from nuclear, although there's still a few names in nuclear that I still love, and still think the secular bullish trend in nuclear will stay intact, but also wanted exposure to oil and natural gas
Mhm.
coming into this year. So more of like a conventional focus on energy as opposed to just a nuclear focused focus on and so that's generally what I write about. I try to just explore trends that don't get a lot of play in the financial media. And really, I don't just want to say like point out the bad news. I mean, the last 2 weeks I've written a lot about these private credit blowups and redemptions because, I think you would have to be nuts to own something like, Blackstone, BlackRock, Apollo, Ares, Blue Owl, any of the regional banks. And so really I do try to issue warnings in areas where I see froth, and that just comes from my professional background of being a professional short seller for many years and, generally being a skeptic and a cynic. And I think, my readers who are wonderful, and I really have some nice, vibrant discussions in the comments and in the chat of my blog. I think that's what they're looking for. I think it's called fringe finance. I called it that because somebody told me that's what my podcast was and they told me that as an insult. And I was like, that's not really an insult. Like, what I'm trying to do is look at issues that aren't being covered in the mainstream media or in the financial media and explore them because that's where very interesting asymmetric opportunities can sometimes be. That's where, a lot of times the media or the sell side will just lie to you about things. And so the fringes are kind of interesting areas for me to shine lights on. And I think that's hopefully what will keep my subscribers coming back.
Okay, so we've got this market that is um, pretty deformed, I think you'd say, and it's a term I'm stealing from David Stockman, who wrote the book The Great Deformation. Coming out of the GFC, things have only gotten I think, far more deformed since then,
Yeah.
especially valuation wise. And even though that may be sort of a new normal, right, that like multiples might be at a higher rate in this new normal than they were before, it's being propped up. And when something's being propped up, it's vulnerable to unexpected shocks it doesn't see coming. And basically, it just means you've got further to fall down the ladder when you do fall. Right now,
Right.
the central planners will likely respond and try to push things back up, but there'll be a period in there where there's a fall, right? And things get rocky and painful. And I think a lot of your readers and my viewers, they're really hoping not to become collateral damage to kind of air pocket moments like that.
Yeah.
So so one of the things that I think you, and I'll pat myself on the back and say I and a number of the folks I bring on this channel have been somewhat early to over the past year plus have been pointing out the concerns about private credit. And all of a sudden, that's kind of headline news right now. And you just listed a whole bunch of companies that all of a sudden everybody's starting to read about, right? Oh my God, these guys
Right.
are closing redemptions and things like that, right? Um, how big of a potential trigger do you see private credit as to perhaps maybe trigger the next big downdraft here that the markets feel? I was just talking with Stephanie Pomboy, like literally right before I came on with you here, Chris. And the analogy we came up with was kind of like the kid whose mom tells him to clean his room. And what he does is he just grabs all the stuff on the floor and he throws it in the closet and the room looks clean,
Right.
right? And he can get away with that for a while, but eventually the closet just
Right.
starts overflowing and it bursts open and all this stuff flows into the room again. Um, I'm curious, do you think that's a decent analogy? I mean, is this something that you
Yeah.
think could, yeah?
Yeah, and I think it's more than private credit. I think that, I've been writing for like almost 2 years now on my blog about commercial real estate also too, and how much ugly commercial real estate paper is on the balance sheets of regional banks. And I think eventually there's some marks that are going to have to be changed in the cows will come home there at some point. I don't know when. I think this private credit event here could actually trigger that, which is why when I said, regional banks, um, you know, to the extent that they have exposure to commercial real estate, which is one area that I wouldn't want to be around. I mean, look, the first headline that came out in December was Blue Owl was trying to get some financing done for a data center and was unable to. And that was the first kind of like crack in the narrative where people were
Hmm.
like, interesting, like, is the AI boom over? Is it a private credit problem? Now, what we're seeing these last few days with this $26 billion fund, the $33 billion fund gating redemptions, um, that smells to me more like a real exodus. And so, yeah, I think, private credit to the extent that they finance other speculative risk on companies, whether AI or otherwise, and to the extent that they're tied in and tethered to other companies as counterparties. Like obviously, there's the potential for aftershocks. Um, you know, I do kind of think actually on last Friday, we got that headline about Oracle and OpenAI and their data center deal in Texas falling apart, and we sold off into the close, and I thought like, wow, like we're gonna have a nightmare Monday. I thought like this is it. This is the narrative breaking right now.
Hmm.
OpenAI is the flagship marquee name in AI. In AI, Oracle, the credit default spreads have swaps have been tumultuous over the last 6 months, and people are wondering, whether everybody's kind of overshot their capex marks, and so it does kind of seem like a little bit of a storm is brewing. And when that deal fell apart, I mean, I kind of thought like we were going to see private credit just lock up like we did with Silicon Valley Bank. And that happened over a weekend, right? Like Friday after hours, I think they put out a press release saying they were fire selling assets to raise a couple $1 billion. And by Monday, they were facing $60 billion in redemptions and were bankrupt. And they brought down, a couple other regional banks with them. I forget who, Signature or some other ones.
Yeah.
So I thought we were going to have the same event over the weekend, and it wouldn't surprise me to continue to see headlines this week because if you're in private credit, like the signs are now obvious. It is being laid bare that it is time to get the fuck out of private credit. You don't need to be a statistician or an actuary or, a CFA level three to know that the front page of the Wall Street Journal is now every day showing another private credit fund under stress. And so, I think we're on the doorstep of a credit event.
Okay, so
Psychologically, once things change, that's it, right? Like once the psychology breaks, that's there was, I think, some fund that offered to tender for parts of Blue Owl's book at like a 30% discount to NAV last week. I mean, okay, like I guess that's kind of like there's a bid out there. There's still money in money market accounts. There's a couple arguments that people can make that there's a bid, but you know, I don't know. Litigation is going to start. People can't get their money. I think more private credit companies are going to face more redemptions. I don't know when this is going out. Today's Wednesday, March 11th, but I wouldn't be surprised if by the end of this week, by Friday or maybe Monday next week, there's a deluge of redemptions that continues.
okay, this is going to go out tomorrow, so this will go out Thursday. So
Okay, cool.
folks will see if that prediction comes true.
People
The-
can tell me
the-
I'm wrong immediately.
yeah. So, but I think the big question with private credit is like how entwined is the private credit world with the rest of the system, right? Like, so in other words, are folks not going to cry that many tears if Blue Owl, if its stock gets hit hard, or Blackstone or whatever? I don't know too many people that love Blackstone as a company.
Yeah,
Um, but one, it's a much more opaque market, right? It's not regulated the way that public credit is, and banking credit
it's
is.
completely opaque.
Yeah, so we just don't know, A, how crappy the loans that have been made
Right.
are, but we don't necessarily know where they lie. And there is connectivity there, like banks actually do make loans to private credit companies who then make loans to
Yeah.
other ventures that we don't know
Based
whether
on
those are
what
good
they're
loans or
based on
not.
where their marks are. Right.
Yeah, so
And, and
how might
at
this cascade is the
at the end of
question.
the week last week, I forget who it was. I think it was a BlackRock. It was a small fund. It was like a 25 million with an M dollar fund, but they wrote it down from 100% of par to zero overnight in 24 hours. There's no, hey, it's deteriorating. There's no, with 100, then 80, then 60, then 40. Yeah, just 100 one day, next day worth zero. And we could see a lot more of that. But yes, you're right. And I always say that things only are laid bare and start to break, and we really only see the big problems after these companies and their executives have exhausted all other options. So there is literally not one more refinancing you can do. There's not one more way they can game the numbers. There's not one more lender they can go to for a bailout. There's not, and so when you start seeing things like gating fund redemptions and these huge markdowns, and it's really, to me, I believe it signifies the end of the rope for a lot of these companies. And then the question is just like, all right, like what is the what's the effect on their counterparties, and how many companies is this going to affect completely?
Okay. So I guess just sort of on your DEF CON meter, right? Let's say one is I'm sleeping like a baby, two is hair on fire. How concerned are you about the potential for private credit contagion here?
What's the scale, one to what?
1 to 10, 10 being the worst.
I would say my conviction level that there is going to be continued redemptions is probably like a nine. I would say that my conviction level that there's going to be contagion across the financial sector that's meaningful is probably closer to five or six.
Okay. And obviously, as new data comes in,
And then, I mean, the key
there's
word
that.
there is meaningful. There's obviously going to be contagion. There's obviously going to be, counterparty effects. The question is, how much of those are going to cascade through, and where's the terminus for each one of them? I imagine some of them end at the larger banks, um, but we don't know.
Okay. But in terms of like, hey, this could be the new subprime, this could be the thing that creates the next, you know,
Well, in sheer size, I don't think it's going to be the housing market crash. I mean, private credit's what, like, a trillion and a half or something, and maybe if there's contagion, it's 3 trillion. I don't know. I don't know. I don't think it's not as big as the housing market, but it's not something to ignore either. I could be wrong also too. I should just look that up before I just talk out of my ass.
all right. Well,
Um,
And look, actually, while you're doing that, I'm just going to mention,
Yeah, all right. So
you
the
know,
housing market is about 10 trillion, and the private credit market's about 1 trillion. So, or 1.5 trillion. So that gives you perspective there.
okay,
But
okay,
it's enough to stir up some shit for sure.
okay. And I'm just presuming we sort of started this conversation with uh, the high valuations of the market. I mean, if there is trouble in a 1.5 trillion private credit market that may have some exposure to the main banks themselves as well, presumably this is something that could, no guarantees, but could create a market downdraft of some sort. Market downdraft that would be painful, that we'd love to try to avoid if possible.
Yeah, for sure. And what'll happen is exactly what happened when the regional banks started to collapse a couple of years ago. The Fed will come up with some program and bail out some will engineer some like sector specific bailout. But yes, this could be the fuse that lights a sharp deleveraging. Everybody was talking about Iran when the war started, and the first article I wrote was ignore Iran, like watch banks, because we
Okay.
had that 2 Fridays ago where banks were selling off, and Iran, that war and that volatility and oil's volatility. I mean, yeah, of course, shops are blowing up and all hell's breaking loose, and that could be the fuse that definitely lights the bomb for sure. But I would, those couple of days when everybody was just talking about the Iran war was dragging down the market, what I was writing about on my blog to my subscribers is don't take your eyes off private credit. Like, don't, yes, everything's volatile now. Oil's volatile. The overall market is selling off, but the the weather vane, the canary in the coal mine, and where the action I think is going to be first is in private credit.
Okay. But just because you mentioned it, so we are at war. Obviously, you've got the risk premium that war brings to the markets. Um, and we've had oil kind of go bonkers, right? I mean, it was up to $120 in the futures market on Sunday night. It's come down a fair
Yeah.
amount since, but still quite elevated to where it was before the war. Um, how right now, how much of a threat are you seeing the war to the prospects for the markets for the greater year?
Honestly, when I wrote about it the first time, I thought it was going to be kind of quick and surgical, like things were in Venezuela. I turned out to eat some crow on that because it's been prolonged now here for a couple of weeks, and there's destabilizing effects across the Middle East. And generally, all hell is breaking loose or has broke loose over the last week or two. But um, I don't know. I really stand at odds with some of my readers on this. I don't think this is going to be a prolonged like months long endeavor in Iran. I think they'll get things tidied up pretty quickly. I think, a lot of the Middle Eastern countries, Qatar and Saudi Arabia, and, all these places all have a vested interest in creating stability in the region. Um, and so I think we'll probably get there more likely than not. I think, I wrote the Sunday morning going into Monday on the day that we had the crude oil spike that basically risk assets were getting sold. The URA, which is the nuclear ETF, was down to 46. Um, and oil had gone up to 130. And I kind of just wrote, hey, like tomorrow, I actually wrote on Twitter, tomorrow is International Short Oil Go Long Nuclear Day. Nuclear trades, nuclear trades with the risk assets. And so that
Yeah.
was getting killed, and oil was through the roof. But you see moves like that in commodities, like, uh, oftentimes they overshoot the mark like significantly,
Hmm.
um, especially in the commodities market. And so the idea there was, I think that's the blow off in crude. I think the worst is over. Um, and I hope for mankind, but also, yeah, I guess for the markets too, that the worst is over in Iran. But yeah, it's definitely going to be uh, something that the market is going to keep its eye on, that investors have to keep their eye on as well.
Okay. And let's assume that you're right, that not necessarily like regime change, but just the U.S. sort of winds things up in the next couple of weeks and says, okay, we're done, at least done for now. Um, how much of a relief rally, if any, do you expect the market to experience from that?
Think it could actually be less than people think. I think that uh, a relief rally assumes, first off, we've had a little bit of a relief rally, right? Over the last like couple of sessions, Trump has come out and said, hey, we're mostly done in Iran. So over the last 5 days, the NASDAQ is green. Over the last month, it's barely down 1%. So we have kind of like come back up. The past 6 months, Nasdaq's still up 4%. So, a relief rally kind of assumes that you were rallying on firm ground to begin with, and I'm not so sure that that was the case. I'd actually be more, I would, I'd be more inclined to think that any relief rally would be shorter. That we may have actually already even seen it over the last 2 days, really, with these comments from Trump. Um, but really also that we'll have a bump and then people will realize they've returned to an overvalued market with a private credit crisis and positive real interest rates. So I think this probably gave people some pause and put things in perspective for some people. um it's not like after Liberation Day where they said, okay, like we're gonna curb the tariffs and everybody just gung ho back in. I think
Right.
I think we're on shakier ground than that now. So I wouldn't be betting all of my money on a huge relief rally here and the S&P to go to 7,500 overnight.
Okay. So the vibe I'm getting from you, Chris, is you're kind of defensive right now, mentality wise, when it comes to the general markets, which, yes, we might be in this new normal where everything is kind of, eternally propped up, but there's a lot of things that are potentially weighing on the market in the near term, private credit being at the top of your dance card there.
Yeah.
So I'm presuming you're a little bit more defensive than normal. I'm curious, where do you see opportunity right now? Like you've mentioned a few things, like you increased your exposure to uh, fossil fuels. You clearly
Yeah.
still like nuclear a bit. I think you still like precious metals and the miners, but tell me if that's wrong. But where else
Yeah.
are you seeing opportunity this year?
So, I've written on my blog my 26 stocks that I'm watching for 2026. So you can get that on my Substack. QTR's Fringe Finance. Like I said, that portfolio this year is at least outperforming the S&P by maybe 4%, at least last I checked. Um, that includes like individual tickers and ETFs, but really generally, from a general sense, like I'll give you an idea. Like I said, I stepped away from completely being a nuclear when it comes to energy and diversified more to nuclear and oil and gas and LNG. I like energy. I am defensive. I like consumer staples. I like the VDC. They had a tough year last year. I like utilities, like anything that's boring that pays a yield. Um, I'm good with. I like the ITA, which is the aerospace and defense ETF. I like the IHAK, which is the cybersecurity, which has just gotten killed with software. There's a big difference between AI kind of replacing people that are using Photoshop and Adobe getting crushed, and saying all these cybersecurity companies are going to be worth nothing. I think that is an opportunistic sell-off that over the course of the long term will pay off in something like the IHAK, which is companies like Palo Alto and CrowdStrike and the others, because the AI is not gonna it's not gonna harm their business. It's gonna help their business, and cybersecurity is really going to be the future, because wars now and in the future, a lot of them will be fought online and through fiber optic cable, and you know just as there's a hot war, there's Cold War shit that goes down, and it's not the '60s anymore. It's done via the web. So I like those names. I think psychedelic stocks are an interesting niche in biotech that nobody's paying attention to, that I think could get a good tailwind from clinical trials that are coming up, clinical trial results that'll be coming up at the end of this year, and they also have an administration that's probably more favorable to them now than the last few administrations, with RFK at the helm and looking into alternative therapies and medicines. So the PSIL is the ETF for the psychedelic names. Aside from that, there's individual names that I like. I've written a lot about PayPal. That's not a huge surprise. That's deep value, in my opinion. $5 billion free cash a year, or cash from operations a year, pays a dividend. They're buying back stock. It trades at 8 times earnings. It's still growing a couple percent a year. It's a mature business, but it's not a dying business in a death spiral. And that's how the market is pricing it. It owns one of the best fintech assets in the world in Venmo. So I love PayPal. In nuclear, I like Centrus, which is the only uranium enricher, domestic uranium enricher in the United States. Howard Lutnick was palling around with their executives at one point
Hmm.
last year. And I think that if the U.S. looks to protect uranium enrichers like it has, rare earth and those types of things, centrist is the obvious candidate to pull closer to the government. Plus, they're the only ones that do it in the U.S. And so, and I think that that's going to, with recommissioning all these nuclear sites that's happening, the increased demand for uranium. So I like LEU in nuclear. And then, other than those sectors, there's a bunch of individual names that I wrote about, little asymmetric opportunities that I think here and there. Yes, like you said, I generally also like gold and silver miners. Still, although not with the same aggressive nature I liked them last year. This is kind of a breather year for them so far. And I expect that they will move up, but not with the pace that they moved up last year. So yeah, that's a general idea of where I'm at. I would like say my positioning is defensive. Like, I'm not super heavy in AI stocks. I'm not super heavy in crypto. Um, Consumer staples, utilities, defense stocks, anything that generates cash and pays a yield consistently. Um, and like I said, little opportunities in psychedelics and a couple other places that I've written about.
All right. I so appreciate you being that transparent, Chris. Super helpful. It's exactly what the folks who watch this video love is to get these ideas to go research themselves. Obviously, you've got, I think you said a list of 26 stocks and ETFs that you put together for 2026. So folks can go to Chris's Substack to get that full list of stocks. And when we say goodbye to Chris, I'll remind everybody where to go. Um, just real quick on software, because I've been asking this question recently, because I've been thinking like you, Chris, which is a lot of these software stocks have kind of gotten hit so badly that it's almost like they're being priced for going out of business, that AI is
Yeah,
just going to totally eat their business. And that will happen with some software companies. But for a lot of the big, the big blue chip ones in this space, something I've been hearing a lot is if you're an enterprise company and need to run an important platform, your sales platform, your CRM, whatever, are you gonna, what would you prefer to use? A battle-tested
right,
software suite that, millions of lines of code that have been, painstakingly put together as every use case has been found and debugged. So it's kind of a bulletproof solution that's out there. Or you're going to go with something that some AI company or some AI model just spit out, right? In most cases, you're going to be going with that tried and true software package for a good long time. And to your point, it's not an and or. A lot of times, AI's a lot of cases, AI is going to work together with these software programs, and AI is going to help these software companies become even better at what they do. So, this is sort of one of the things I asked about a relief rally. Like if the war kind of dies down and the market's immediate fears about the wars diminish, it's going to start looking around to say, okay, well, where should I put money to work? And it seems like the software space might be a pretty obvious candidate of like, wow, this thing's really been beaten down. Time to get
right.
back into the pool. Do you think that's the case? Or that's more likely than not?
I think probably there's going to be select names that will be negatively impacted and other names that won't. I actually tried to handicap this a little bit last week. I was looking at Adobe. Adobe's trading at like 15 times earnings now. They're a staple in, any type of creative arts that you can do on a computer. And the idea is like, okay, like is AI going to replace, human ingenuity as it comes to graphic design, as it comes to video editing, and I do think that there's um, a case for that. But I also think there's a stronger case for Adobe integrating that into their suite and, kind of moving alongside that and growing with that trend. It's not, there's far more dangerous industries to disrupt, right? Like you disrupt like the airline industry by coming out with a way to teleport. Like, all right, that's it. Like the airline industry is done, right? Like, but software can be rewritten. That's the whole point of software. It's software, and so it's code. And so, you're arguing that, say, some code is going to interrupt an entire sector based on code. And it's like, maybe they'll just adapt. Maybe they'll come up with some like hybrid model. So that's my like terrible analysis of software. But I did read, I can't remember off the top of my head, but I was reading some statistics, maybe on Zero Hedge last week, just about how badly software has gotten crushed. I think it's the IGV, right, which is the software index. Let's see. Yeah, that's the expanded tech software sector. So that's down 24% over the last 6 months. It's down 20% this year. Uh, Still up over a 5 year period. But yeah, I don't know if I had to pick one. At a PE, at a blended PE of 30x, it looks like I would, if I had to choose, I would be more inclined to buy software than sell it here. That would be my, you know. But again, I'm not a financial advisor and generally have no idea what I'm talking about. I'm a former bartender.
All right. Well, look, we got to start wrapping up here, but let me just ask you this, Chris. You write about a lot of topics. Is there anything else that's kind of burning brightly on your radar or your interest set that I just haven't thought to ask you about yet?
I'm just looking here at like the first page uh of my blog, and I think we pretty much covered everything. The only thing I would recommend actually is if you go to my page, my blog page, the free article, you don't have to like read, you don't have to pay to read it. It's called AI Now with Less Circle and More Jerk.
It's such a great
And
title.
and that was a human thought of title too. I didn't run that one through AI. But if you go in there, there's a link to Michael Burry's podcast from December 8th of 2025. And one of the things he talks about on that podcast is the similarities that he sees in the tech boom where fiber optic build out got way ahead
hmm
of what was needed and how that compares to AI and how he thinks the build out in AI now is getting far ahead of what we need. And this goes back to, when companies start reducing CapEx, is the market just going to get crushed? And that's a worthwhile listen if you want to kind of keep a pulse on tech, but the overall markets in general, because that's what's driving everything now.
Okay. I actually haven't listened to that interview yet, but I definitely will. Does he get into at all the circular financing concerns of the industry as well in that
I
discussion?
don't I don't remember with specificity whether or not he does, but it's certainly worth mentioning. Yeah, that again, it's same deal in private credit, right? Like one guy loans to another guy and his collateral's worthless, and he loans to another guy and his collateral's worthless, and
Right.
these
Well,
these
and we
companies
and we
have
saw
these
that in the
companies have
dot-com
hundreds of
boom.
billions of, yeah, and we have companies with like hundreds of billions of dollars of these partnerships down on paper, that nobody knows whether or not they're going to be able to actually effectuate them. So, it's worthwhile to note.
All right. Well, Chris, look, thank you so much for coming on. Great update. Again, thank you for being so generous and going through the things where you see opportunity here. I love that it's not just about concerns, it's where opportunity lies. For folks that would like to follow you and your work, you've already mentioned it once, but where should they go?
Yeah, it's just quotheraven.substack.com. So quoth the Raven, Raven dot Substack, Substack.com. Or
All
just go
right.
to Substack and search for QTR's Fringe Finance.
All right. Well, Chris, when I edit this, I'm going to put up the URL right there on the screen so folks know
Cool.
where to go. Folks, the link will be in the description below this video too, so you can get there with one click. I got to ask, Chris. So, Quoth the Raven, obviously a reference to Edgar Allan Poe. Just curious, why'd you pick that one for your Substack?
It was a long time ago. That was the moniker I was using since like 2012 when I started writing on finance kind of anonymously. There was no real reason for it. I just needed to pick a moniker. I was
Okay.
an
You
English
you weren't like an
major.
English major or a
I
Poe
was an English
fan.
major.
You were?
Yeah.
Okay. Well, there we go.
Yeah. So I did read some Poe, and I actually like, some of Poe's stuff, but there's no like, no crazy like allegiance to him or big crazy story. I was filling out a form for Seeking Alpha, and they were like, what's the pseudonym that you want to use? And I was like, maybe I had some book or some shit on my desk. I was like, Quote the Raven, like whatever. I didn't know, 13 years later that was going to be my name of everything, but now it is what it is. So
Yeah.
no,
Well,
no
and
real good story.
Well, congratulations on the success. And look, you're a great writer, so there's something you got in common there with Poe. And obviously, the results show that, given the extreme popularity of your Substack there. But it is just interesting and kind of fun to know that you got a literary background.
Yeah, for sure. Yep.
All right. Well, look, Chris, again, can't thank you enough. This is it's
Thank
been
you.
wonderful. Look forward to having you back on again soon.
All right. Sounds great. Thanks, Adam.
All right. Well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined this week, as usual, by senior partners John Lodra and Mike Preston. Mike, let's start with you. Love to hear any key takeaways that you have from the conversation just had there with Chris, and obviously we'll talk about what the market's done over the past week. I guess in particular, the thing that seemed to be burning brightest to me on Chris's radar is the mounting concerns that we're starting to see in the headlines around private credit. Are you guys noting the same at New Harbor, and how concerned are you guys about how this could potentially metastasize from here?
Yeah, hi, Adam. Thanks for having us. And Chris certainly talked a lot about private credit there, maybe being a canary in the coal mine. It's certainly something that we're watching here and noticing. It's hard to tell whether this is going to be a contagion or not, or is it just a minor nuisance? I think Chris said something like the on a scale of 1 to 10, if he thought this was going to cause problems or credit problems, he thought maybe a 9 out of 10 likelihood. But in terms of a contagion, I think you said 5 or 6, something like that. So
Yeah,
it,
more like it would beat up the big private credit companies, but not so much potentially spill into other parts of the system.
yeah, so let me just share a couple quick charts. These are on a daily basis. Here's Blue Owl Capital, and they had, I think a week or two said they're going to start to gate redemptions, meaning you can't take money out of their fund. OBDC, I think, is their fund, and it's been in a big downtrend. But take a look at some of the other big names. KKR, for instance, has been in a big downtrend year to date. I mean, that's down a lot. That's what, 30, 40% year to date. And BX here, Blackstone, way down. Even if you take a look at the iShares financials, you can see that that's been a really negative sector. I mean, this used to be in our model. Last year, we got out of this somewhere around 51, 52, maybe 4 months ago, something like that, because it's been in a downtrend a few months ago. But so there's certainly some concern about financials, particularly private credit. What's it going to do? I don't know. I don't think anyone really knows. It's something to watch, something to be concerned about, particularly in a hyper overvalued market. I mean, if I can, I'd like to just share a couple basic charts about valuations because Chris started and said, you know what, after all these years of money printing, here we are at at a point where maybe a PE of 20 is deep value. I know he was being sarcastic, but people like us and individual investors don't even know what way is up sometimes anymore because valuations have been so darn stretched for so long. We just don't know if this is the new normal, and you still need to operate in this environment. So it's tough. So let me just share that chart. Actually, two quick charts here, very, very basic charts. This first one is the Shiller PE. Professor Robert Shiller of Yale famously created this. It's a 10-year smooth inflation adjusted price earnings ratio. This goes back to 1880. You might say that the average on this is 10 or maybe 12, something like that. Prior bear markets didn't clear until the single digits back here in 1929. Actually, this would be after the big, right here, 1932, after the big Great Depression, cleared at maybe 5 or 6. Back here in the 80s, we hit a low at maybe 6 or 7. But starting in the 90s, we went way off the reservation. We hit a PE of 45. We did come back to 15 at the bottom of the housing crisis, but that was rescued. And we were here for what felt like a millisecond. And this is not a good timing tool, but it shows you how overvalued this was. But take a look at this chart, which is John Hussman's chart. This one's a few months old, but I just had to go back to John Hussman's work because his work is so good and show you going back to 1928 what his measure of valuation shows. If you take a look at this green line, this is what the market would have to be at to yield 10% future returns. And if you look at what happened in the late 90s, the blue line is the actual S&P index. And so we came out of norms in the late 90s and we never went back. This is the kind of point that I want to put across here. The low of the tech bubble did not touch normal valuations. The low of the housing crisis touched normal valuations for what felt like a millisecond. And then the world went into infinite QE. And here we are again. This is a few months old. We're actually a little higher now. We'd have to fall to like maybe 17, 1800, 2000 on the S&P to have 10% return possibilities again. Well, I think you can do the math on that. That's a drop of over two-thirds. And in fact, we think that's what's likely eventually to happen. But what Chris was talking about there is, what kind of faith should we have? I think, if I could put it in my own words, should we have faith that we're never going to reach these norms again? Or should we have faith that math really does matter? So, yeah, I think we fall into the latter camp. We think that valuations do matter. That doesn't mean we're not playing the game, but we're playing the game relatively conservatively.
Okay. And I'm trying to remember from the last time we talked. I know that the guys at RIA, I believe, have recently brought down their equity exposure a little bit, but it was at a pretty high level for them. Have you guys reduced any of your equity exposure yet in the wake of recent things that have been going on?
We've been at about 47.5% for a few months. So I'm going to share another screen while I'm answering you here. So the first thing you want to do in any environment to set what your risk exposure is. We're at a hyper overvalued environment. Our risk exposure is set at 47.5 on equity, excluding the gold stocks that we have because we count those as different. And that's because we know we might be wrong about the fact that we think that presently this market will likely hold up here for a little while. Nobody knows what's going to happen next, but we have a set of indicators we trust. So here's the S&P. I'm going to zoom in a little bit on a daily chart. Take a look at the S&P right here at like 6,800. You could go all the way back to late September, early October, and the S&P is trading at the same place it was 5 to 6 months ago. That's driving people mad a little bit. It really has gone nowhere. The Nasdaq is similar. And the S&P over the last few months, year to date, has been tracing out this big triangle. We recently broke to the downside on this triangle. Is this going to be a fake triangle breakdown and we reverse up or not? We don't know. We're going to have to wait and see. But to answer your question about risk exposure, based on valuations, we're hideously overvalued. And we have our suite of indicators, which have been in green for quite a while. Over the last week, they turned red. Because of that, we added S&P index put hedges down here at 6,500. So if we get a big crash here, which we don't know, we really can't tell. I don't think that's going to happen, but we'll see. 15% of our exposure will come right off the top because our index hedges are at 6,500 for 15%. That'll drop us to 32% overnight. And then from there, we'll probably start taking stops on our sectors and reduce from there. So unlike a lot of other managers out there, we'll be reducing into a downturn or crash versus saying, don't ever sell.
Hmm.
So that's where we stand right now. I'll stop sharing.
Okay, so basically your default isn't a big breakdown from here, but you're concerned enough about the potential of it that you've bought some insurance there at 6,500.
Yeah, one thing that's tough about this business and for individual investors out there is you have to have some kind of bias because the truth is there's no set of indicators that will just print money. Wouldn't it be nice? You
Right.
have to set your exposure based on the environment. The environment is relatively risky, so our exposure is low. From there, it becomes tactical. If I had to guess, I think we might actually have had a false breakdown and springboard higher. Chris said that if the Iran situation was resolved, he didn't think that the market would react. I kind of disagree. I think the market might literally react and break into new highs that could even cause some type of blow off. We would welcome that blow off because frankly, I think this market has a date with destiny ultimately to for a long bear market. And so we're kind of in this false environment where everything is stimulus, stimulus, stimulus. And so people are a little bit going crazy, I think, watching all this. So we don't have to guess overall. We added our hedges on. If we get a crash, we'll be okay. If we get a blow off, we'll know what to do and we'll ride some of that as well.
Okay. Mike, do me a favor, pull up that chart just one more time. Um, the question I want to ask you, we've talked about this a fair amount in the past couple of times you guys have been on, but the market hasn't done much since September. Do me a favor, just pull out a little bit more there if you can.
Sure. And I can even go to
Um,
weekly. Maybe it's going to be better. Here's a weekly,
yeah,
you
yeah,
know.
yeah. Okay, that's actually great. So at what point do you stop thinking, okay, this market's likely consolidating and it's going to eventually break out to the upside and we'll get new highs versus this looks like a topping process. And I
It
and
does.
and I don't think we can say it definitively here, but you can definitely see now it is rounded over unless prices go up high pretty quickly from here. Um, and it's done so over the course of 5 months or so. So at what point do you start getting concerned that like, okay, this thing looks like it's heading down?
I'd say the last swing low here, Adam. Right back here, 6,500 back in November. We touched 6,500. This big horizontal red line is at 6,500. That's why our hedges are at 6,500. If we have a meaningful break and let's say a couple closes below 6,500, I would say that we'll be a lot more concerned. But by then, as I just mentioned, our equity exposure will automatically be lower. Furthermore, we'll probably take some stops and because we don't really want to say never sell like the rest of Wall Street says. We don't want to be adding on a downturn because we're expecting the big one, quote unquote. Going back to some of the valuation charts, at some point something big is going to change and the world's going to figure out QE doesn't fix things forever. And the market could lose two-thirds. In fact, it will likely lose two-thirds as we go through the final few years of this fourth turning climactic cycle that we're in. And so we don't want to mess around with the big one. But at the same time, take a look at this chart. We're like 3% off. What? This is 220 points between here and the high. That's 3%. One day or 2 days, and we could be busting through to new highs. And
Right.
so at this point, if we have a big uphammer on a weekly or daily chart even, and we come through new highs, I'm going to say that some kind of bullish blow off is probably in play, particularly if you see a few hundred points in a short period of time. If on the downside we come through 65, well, we're probably done. We're probably done for maybe for a long time.
All right. Thanks, Mike. All right,
Okay.
John, I'm going to pull it over to you here. Um, so we have, a couple of potential downside triggers here. Obviously, private credit's one, and would love to hear any thoughts you have about that. And I guess maybe a question for you is sort of similar to what I asked Mike there. At what point would you start really getting worried about private credit becoming, you know, something that could cascade into other parts of the market and start pulling, things down with it? But we've got the war going on, and yeah, let's all cross our fingers and hope that it's over quickly. But it might not be. And certainly, investors have been really worried about what a sustained rise in the price of oil could end up doing to the economy overall. And I'm sure I could pull up some other concerns there. I think I mentioned to Chris, you know, we've got data on both sides, but the latest payroll data that came out from the BLS was pretty concerning. So, how worried are you about, or are you worried about any potential pins here that could really prick these, borrow from Chris, pornographically overvalued asset prices?
Yeah, thank you, Adam. And I think Mike did a great job covering our take on things. I want to talk about private credit in just a moment. But let's talk about, and to be completely honest and humble here, I think Mike would agree when I say the last 15 years has probably been the toughest years we can imagine as a fundamentally data-aware investor. I mean, when you look at the valuations, valuations are not a timing indicator. They never have been, they never were, and they aren't now. But the degree to which the usefulness of valuations have been timely exercisable has been greatly interrupted. I'll say at least. So you could probably make a fair case that just on valuation on loans, 0% equity exposure, but that would be exactly the wrong thing to have been. So that's why, we rely on a whole bunch of other stuff beyond. And the way I would think about valuations is kind of like an analogy of, at some point markets will fall, the elevator will drop, and a prudent investor's got to decide how many floors up they are comfortable being when that happens. Do you want to be up 100 stories or 10 or 5,
Hmm.
right? That's a simple analogy, and our way of expressing that is just being somewhat underweight equities, and even better, hopefully underweight equities. But the equities we're in are ones that are outperforming the broad market. And that's easier said than done, but it's certainly what we try to do with our systematic tools. Um, we are in a point of indecision. Mike just showed up the S&P chart, and it's kind of like this sideways range. And traditionally, the logic is that's going to break one way or the other. And until the trend is broken, the assumption is the trend is going to be kept. Mike talked about some key levels that if we saw taken out, would be a further affirmation to us that things are not as hunky dory with the stock market as one might think. So we're not complacent at all. We are very hyper focused and vigilant. But I do want to talk about, so even though the S&P has gone nowhere, doesn't mean there haven't been opportunities. And this kind of echoes off some of Chris Iron's comments. Energy, for example. Here's oil and gas services companies. They have absolutely exploded higher, not just since the war, but actually they've been rallying since the September-October timeframe when the S&P basically stalled out. Okay. Things like global base metals companies. Let me just pick up another ticker here that follows those. They've done tremendously well. Emerging markets on a relative basis have done very well. Right, so there's been areas of strength, even though the market has been frustratingly in a cap-weighted S&P context, frustratingly nowhere. But what does have us concerned is some key sectors of the market have been really, really weak, even though the broad market has gone nowhere. Look at the financial sector, and we'll talk about the private credit in a moment because I think it's certainly starting to flow through to the financial sector. Generally, when financial stocks struggle, it's not a good sign at all. Okay, it doesn't mean the world's coming down, but it's not a good, healthy sign. Look at retail stocks, as a sign of consumer health. Those have started to falter quite dramatically. Look at home builders, for example. They're falling out of bed. These are the cyclical type of sectors that you don't want to see turning over if you're going to have a durable follow through to an uptrend in the market. So that's just some comments on the stock market, and I want to talk about private credit, but I'll pause here to see if you want to talk about any of that, Adam.
No, I think it's all good. I do want to connect some dots from what you just showed to private credit. So why don't we go to private credit and then we'll do
Okay.
that.
So I'll be honest, we were afraid of private credit years ago. We're afraid now, but more importantly, we were afraid a couple of years ago. And there were a lot of good, headline reasons why we felt that way. You look at the private credit kind of class, the loans that are made in that class, generally lack the kind of financial covenants that bank loans and traditional bank lending provides, basically protections for investors. And it's probably a year and a half now. And our industry does a great job at pitching products, especially when they're hot and they offer a nice juicy yield, which private credit certainly was a big selling point there. Hey, look at these great yields on these private credit loans. Isn't that great? Wouldn't you like 8 to 10% a year? Well, there is risk, and we're starting to see that now. But we get pitched by a lot of financial product companies. We have to keep a pretty solid lock on our doors and our phones, to be candid. Because there's not a day that goes by where we don't get pitched on a lot of stuff. And we've been very reluctant. We've raised a lot of these issues with a lot of those firms. And I recall being at a investment forum held by a very large institutional manager, one of the leaders in the private credit and bond investing space in general. And there's probably 300 advisors in the room. I asked the question, are you concerned about these lack of covenants, this and that, the headline talk about public and private marks to markets not being the same? And they kind of sloughed it off. They said, yeah, there's, covenant light loans, but, at the end of the day, they sloughed it off and said, but if you're going to invest in this space, you want to be with a big company like ours, because when it comes time to negotiate with these borrowers when they're up against the ropes, we're going to get a better deal. So it's kind of almost like a tacit admission that day will come, but don't worry, be with us and we'll get you the best deal. It blew my mind. So we've been out of the space. We haven't succumbed to it. So we're not worried about it in that our clients aren't invested in it, but we are worried about the contagion. And it's impossible to put a bound on that, other than, I would say, as history would attest, generally speaking, it's worse than it appears or worse than the headlines would want you to believe. I'm going to share back last May, and it's not just the private credit. I am a little bit more than a little bit concerned about traditional financial firms having a contagion. So this is a study that the Fed put out last May of 2025, and it's entitled "Bank Lending to Private Credit." Let me see if I can make that a little bigger, just in case uh, you can't see it. But the title says it, "Bank Lending to Private Credit." So there's some great charts in here. Let me scroll down. This, first of all, this is what happened to private credit through different, BDCs, private debt funds, and you can see there's been an explosion. And one time-honored lesson is when something increases dramatically in the financial product realm, it usually is a sign of being overdone. And that's just one data point. So you can see the absolute stunning growth there, right? But then you see the bank exposure to that. This is where was it? There was a chart in here somewhere. I might have jumped over it. Oh, that's the bank. That's the bank. So essentially, what happens here? Traditional banks lend to these private credit firms, who in turn lend out to private credit borrowers.
Yeah, this is what I
That
was saying to Chris, right? I mean,
yeah.
so, you know, some people say, well, don't worry, it's going to be contained to the private credit space. Well, it's like, no, these private credit companies get a lot of their loans from the traditional banking system.
Exactly. And I don't know if it's a loophole in the system to get a, I don't want to be that conspiracy theorist, but I think there probably is some element of the capital rules and kind of the restrictions that were put on lending in the wake of the financial crisis. I think instead of banks lending directly to borrowers, they found happy intermediaries in the form of the private credit funds. So I wanted to share that. You know, what we have seen a lot, another thing that has concerned us, again, back to our industry's mastery of putting out products, a lot of the retail private credit products are built on what are called a secondary market. Do a quick Google search, private credit secondaries. Essentially, what this is, it's a way for either general partner private credit funds or the limited partners that invested in them to achieve liquidity on their investment by essentially selling it to secondary markets. And a big part of that secondary market are retail investors. Again, I don't want to go so far as to say, criminal acts or anything like that, but there is this notion of the small guy holding the bag while the big guys are trying to get out. And, I think it's not coincidental that last August there was a presidential order called what was it called? The title, I think does it full justice. Democratizing access to alternative assets for 401k investors. Basically, under the auspices of, hey, let's let the little guys get access to these great, private investments that have only been reserved for the big guys. Let's let them start to put it in their 401ks. We shook our heads. It had all the markings to us of let's find the retail small mom and pops to hold the bag. So
Let's
so
find
yeah,
the
I'm not
sucker.
going
Yeah,
to.
let's take all our
Yeah,
underperforming stuff and give it to them. Yeah.
I don't want to get overly alarmist, but I do think there's probably much more pain here than the authorities, talking heads want to communicate. It always is that way. It was that way in the housing crisis, and the things like seeing the financial sector as weak as it is tells me that there's probably something to worry about here. Just like in the almost year leading up to the subprime becoming a problem, financial stocks were struggling, even though the market was doing great. But, pretty much all of 2007, you look at the financial sector, even going back to late '06, I think, the financial sector was struggling in the stock prices. Why? We didn't know until, subprime became a household name, but that's the market come told us. So
Okay. I'm looking at the time here. John, I want to come back to you with a question about kind of what to do about all this. But Mike, if we can, let's just do a really quick dial through what's going on with the precious metals here. Um, from my perch here, uh, still a little TBD, but it is looking like we staunched the bleeding from the big correction that they had from their highs. Now, we had expected that they were going to go through a pretty big correction because the price action had just gone exponential. Um, but what are your charts telling you about where you think the precious metals are likely to be heading from here?
I'm on mute. I'll try to keep it really brief here, Adam. And hopefully you can see that now, the chart
Yep.
of SLV, which is an ETF that follows silver. Now, chart reading is a little bit hocus pocus, I realize. It doesn't necessarily tell us exactly what's going to happen next. In fact, it never tells us exactly what's going to happen next, but at least it can give us an idea. This purple line that I've drawn is a rough trend line that silver seems to be respecting. We had a big blow off here, and you almost have to just take that right out of the equation because, well, I think we all knew it was kind of crazy. It's kind of like what oil just did. Oil just went crazy and then came on back down. But this is still in an uptrend and it keeps hugging 85 to $90 spot. I mean, who would have thought that we would be settling up here a few years ago or even last year? We were talking about a big triple top breakout at 35 and now we're settling at 80 to 90. In my opinion, you could almost throw out this point and just take a look at this. This is doing some good things here. All this consolidation. If I move this to, let's say, the weekly chart, we had this big parabola, but this back and forth going on between 70 and 85 on SLV, which is basically what, 80 maybe to 95 on silver, looks pretty good to me. And therefore, I think it's building. I think it's building. I don't think it's like the other big tops like 2011, 1980. We seem to be recovering pretty well. And on down days, I'm just noticing watching the tape that the miners are being bought up. So I know it's talking our book a little bit because we're still 10% miners, but I do believe, and we actually have a trading piece in SLV as well. I do believe that these names are likely going higher. And so let me just take a look at SIL for a minute here.
Sure.
SIL down a little bit today. This is silver miners. But if I back this out to, let's say, a weekly chart, we can see that SIL went from 40 to 80 last year. So it doubled. And Chris said he's also positive of the miners. He doesn't think that we'll have the same performance. I'm not so sure. I mean, maybe we go 80 to 160 this year, or maybe we only go up, I don't know, 50%. But the big bull markets, I've said before, usually double once, and there's a big double off the base. Normally there'll be another double before this thing's done. I can't imagine that we have 1 year outperformance and that's it. Particularly if gold and silver hang in there. Going back to the daily chart, let me bring up gold. Look how well this has been hanging in there. We had this blow off top, and it's just been straight uptrend. And this is gold here at 5,100 or 5,200. So I believe these gold stocks have 50 to 100% more in them. I don't know that that'll happen this year. In the metals themselves, I'd continue to hold as long as your allocation is not out of whack. So I think it's very bottom line, very positive.
Okay, and as we're seeing the earnings start to come in for these mining companies with precious metals prices way higher than they were a year ago, um, is that starting to catch Wall Street's attention, do you think? I mean, do you anticipate the miners to catch another bid here soon as Wall Street just can't ignore their heightened profitability?
Yeah, I mean, in general, the earnings were really good. The market seems to have anticipated them because in general, these stocks did not have huge gap ups. In fact, today I'm looking at Harmony Gold, HMY. They actually are down 12% on earnings. So I don't know if that is, I don't think that's anything to be worried about industry wide. I haven't had a chance to read that. I would say that most of the earnings surprises have been up. It seems like the market isn't really convinced that the metals are going to hang in here at this level. But with that chart, like I just showed you, with silver 80 to 90, and certainly if it continues to hold that level and or go higher, I think the market's going to have no choice but to be convinced that these multiples are going to be worthy of expansion, and the record profits are probably going to be here for a lot longer, and that means higher stock prices.
Okay. Well, we'll have you tracking it here for us on a weekly basis going forward, Mike. John, coming to you for a wrap up here. Um, so, obviously, lots of reasons to be concerned about, potential risks to the downside here. We've talked about a bunch of them with Chris and here with you guys. As capital managers, um, there's a lot of people watching this channel who probably had a pretty good 2025. Are probably watching the action here in 2026 and starting to feel a little bit nervous, but I'm going to guess maybe most of them haven't really changed much about their portfolios since the end of last year. Um, is this a good time for, the average investor, folks watching this channel, just to kind of do kind of an audit of what they're invested in and just, you know, take a fresh appreciation of the risks and just ask themselves, hey, should I be taking some maybe more defensive measures in my portfolio than I had coming into this year?
Yeah, Adam, I'm not going to mince words. Absolutely, yes. And that's not synonymous with freak out over headlines. I mean, yesterday there was some big market moving things on a tweet that was, and then it got taken down in terms of, escorts of, vessels through the Strait of Hormuz. But no, I mean, again, going back to the valuations we just talked about, even Vanguard last year, 2025, the profit of passive investing, index investing, basically said, hey, valuations are stretched. It would be prudent to think about underweighting equities what you otherwise might be. So, even Vanguard has kind of acknowledged, not with perfect timing, but from the standpoint of a person's life, a couple's life, a household's life, and what they need to do. This is not a time. One of the biggest dangers, or it's not the market risk, it's not the fraud, issues in the market. It's oftentimes one's own psychology, a fear of missing out. This idea that, geez, if I miss the 10 best days, I'm gonna be forever doomed. There's so much that's a big part that most individual investors really need to get a handle on. Do I need the returns that I'm fearful of missing out on? Everybody wants returns. Let's face it, everybody wants the returns, but do you need them? And it's not a God-given right for more return if you take more risk. In fact, there are parts of the market cycle where absolutely that equation gets turned on its head, that more risk just invites bigger downside, bigger losses. That's not fiction. It's not something making up. It's actually in the data. You just have to understand that there are parts of the market cycle where that coin flip is very negatively weighted, and there are times where it's very positively weighted. And valuations are just one of those things that, tilt the odds on that coin flip. So absolutely, yes, review your exposures, review your allocations, don't freak out, but bring it back to your own situation and be at peace with some level of regret. You're always going to regret something. You're going to regret not buying enough, buying too much, selling too soon, buying too soon, selling too late, selling too early. That's part of the game. There is no such thing as perfection here. So come to grips with that. That's going to be the most important arsenal in one's psychological and investing toolkit, more so than tactics or strategies.
All right, very, very well said there, John. And I'm getting a sign here from my computer that for some reason it looks like the memory is getting real low. I think my video might even be a little bit delayed here. So we'll wrap things up real quick. Hopefully this works well. Folks, if you'd like to see Chris Irons come back on this program again soon, please let us know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you would like to get some help in doing, what John just mentioned there, highly recommend you get that from a good professional financial advisor. If you don't have a good one who's advising you, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to even John and Mike themselves there at New Harbor. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful as possible. And a reminder that Thoughtful Money's spring online conference is just a little more than a week away. You have a couple days left, I think like 3 after the day this video airs, to buy your ticket at the last chance to save price before it jumps up to the full price. We've got our best faculty ever. I won't go through the whole list because it's quite long and I'm worried about the memory lasting here, but you can find out all the information about the conference and buy your ticket over at thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, check your email. You've got a code for me you can use to get an additional $50 off whatever the ticket price is when you go to that URL. John and Mike, gentlemen, great week. Can't thank you enough. Very interesting times, a little scary, but thank you guys for keeping us on track every week. Look forward to doing this again with you next week, and we'll cross our fingers that hopefully things get better for the market outlook than worse from here. But again, guys, thanks so much for doing this.
Thank you, Adam. Always a pleasure, and we'll see you soon.
Thank you, Adam. Nice talking with you and enjoyed it very much. See you soon.
All right, everybody else, thanks so much for watching.